Republic.
We are live right now. We're live on YouTube. I am here with Chris Jacob, and we are going to be giving you the third quarter review of what the stats are in the city of Austin for the real estate market. If you're watching this for the first time, please do me a favor and like and subscribe. You know, Chris and I go on do one of these about once every quarter. We got Chris is an amazing analyst of data, and he runs the housing report on Facebook. And we're gonna just dive in. So, Chris, you know, what are we seeing now? We're past the third quarter. What are you seeing happening out there on the market?
You know, Ryan, what we're looking at is we're actually kind of seeing a return to some normalcy in the market. Months of inventory are up. They're hovering about 4.5% today, or 4.5 months today. Pending sales are down. Last quarter, they were down about 28%, and values are still holding strong. You know, year over year, quarter over quarter, we're seeing values up about 13% compared to the same quarter period last year.
Yeah.
So it's pretty healthy.
This is pretty healthy, but what we've seen is in the short term, in the 6 months, a reduction in value. Is that right?
You know, we've seen a small backup off our peak.
Yeah.
So our peak value was in Q2 at about, Q2, we peaked at 690,000. Our average transaction value in Q3 was 641,000. So that's about a 5.5–6% reduction.
Yeah. Well, you want to take a look at these, at your numbers while we're doing this?
Yeah.
Okay, whoops, wrong one. Let's go to, there we go. There we go.
I don't think they've come up yet.
They're on the screens. You might want to look at it on yours. They're on YouTube.
Okay, awesome. So what we've got, we're looking at the middle column. That's kind of, God, it looks like a middle finger now.
Yeah, solely right. Sold listings.
Now that I say it aloud, what you see is we're kind of in a normal curve. We're returning to a more normal curve. Q2 typically is where we see our peak values in a normal cycle, and you can see that happened last year for average close value. And this year we're in that same kind of cycle. Our dip's a little greater than last year, but it's not uncommon for Q3 and Q4 values to dip year over year. And what's really kind of interesting, we've talked about this purgatory we've been in now for a couple of years. I think the ending of the quantitative easing has shocked Austin back into a normal real estate cycle. You know, we aren't artificially creating demand through low interest rates. We aren't artificially, subsidizing the mortgages for people, and the mortgage rates are floating freely, which, we don't like these in the sevens, but the reality is 7 is historically now for a couple of years.
Oops, hold on, sorry.
I think this...
Go ahead.
No. Yeah, the 7% rates that we're seeing floating around, those are historically great rates if you consider the 90s, the early 2000s. 7% we all would have been happy with. I think the market's still a little shock over the rates after being addicted to the cheap credit that we've had the last 2.5 years. But it's kind of nice to see, and I hate to say it because 4.5 months inventory is a big game changer for our sellers, is it's back to some normal. We can actually go look at homes. We can actually go out and show them 2-3 times versus you have 7 minutes to decide, is this the house?
Yeah, and one of my agents put a video out on TikTok yesterday. I thought it was really good. Is that we have so much negotiability in the market that in some cases, not all cases, but like if you're looking at a home and the 7% is freaking you out, right? Then ask for, first of all, reduction on the price. Ask for closing costs, which you couldn't ask for a year ago, and with the $5,000 closing credit or closing cost credit, you can buy down that rate 2 points almost.
Absolutely. And if you think about that negotiating, last year this time people were paying about 105% of list price for a home. This morning that rolling 30-day number is 97.7%. So the buyers are actually in a far better negotiating position than they've ever been in. Yeah,
right. And there's inventory. So, and so when you look at I know I had some, what do you see going in the new home build market right now?
So new home build market's still plagued with slow delivery of inventory. They're really working through their supply chain issues. A couple of the builders come out and said we've compressed our cycle times from the historically long periods. But new builds, I have preliminarily started to see some new builds year-over-year numbers might be showing some retraction compared to last year.
Yeah.
But they are actually inside the average sales price for the same period for the incoming pendings. So there could be a year-over-year step back in early Q1, Q2 next year where home builders are selling homes for less than they were this year.
Right. And that's kind of, I mean, that sucks for people that, you know, that bought, like we have one client that bought a property, and 2 days later after he closed, they sold, it was like $950,000, and they sold one for $150,000 less than that, which was, you know, that sucks, right? At the same time, you know, you got to say that when you buy a home, you got to look at it from, you know, minimum 3 year, more likely 5 year hold, and I think that they'll be fine.
Yeah, homes are a long play. They are not short-term investments. If you really kind of buy and think you're going to sell it in 6 months for a gain, you should go play the stock market.
Yeah.
You know, real estate is a long-haul investment, and I really think this artificially low rates and these peak prices paid are going to create a generation of accidental investors. That in 20 years, they might look back and go, oh my God, that was the best investment I ever made.
Yeah.
Because it started to produce income at year 5, it positive cash flow for almost 2 decades after that. It shot up in value, and you know, when was the last time you saw 3% mortgage rates?
Yeah.
So I think we're going to see a generation of accidental investors come out of this.
That's right. And what you're also seeing is a great increase in values for rental properties. I mean, as far as rental rates are going up, you know?
Yes, I saw an article last night that said Austin's rates have doubled in like 3 years. And I was like, geez.
Yeah.
It's just crazy.
So now that the tax bills are going out, I remember we talked about this before. We talked about the increase of taxes to investment properties, and I think what you said is that they're limited on how much they can actually increase. What do you have you looked into that? And I don't put you on the spot.
I have. No, and I honestly have not looked at what the impact is on tax bills.
Yeah.
I know when they put that cursory tool out where you could go check your personal properties.
Yeah.
My house is Central Austin. I'm in Brentwood. It actually went up like $100.
Yeah.
Because of the homestead cap and then the budget caps.
Right, the budget caps. That's what it was.
Budget caps, yeah, the 8% budget caps that the state has. So as a homeowner, I'm looking at it going, okay, they increased my value the maximum, but they only yielded $100 in extra tax money.
Right,
which is astronomical.
So even though a value of a property may go up 50%, they're only going to be able to increase that tax by 8%. Is that what it is?
They can only increase their budget by 8%.
Yeah.
And then they drive it backwards into, okay, X number of dollars goes, homestead people are going to pay this, not homesteaded, which is your raw land, your industrial, your investments. They're going to bear the larger burden, but still there was that mechanism to capture the budget, or cap the budget, so that it just wasn't a wild card, slippery slope. So I haven't done those analysis. That was something I was going to look towards later in October because of the multi-counties I deal with.
Yep.
I just didn't want to start working on one and, you know, stop and go.
Okay. Let's look. I want to look at this chart again. I've got it pulled up.
Yeah.
So, you know, you've got 20. Let's go to Q3. Your 20. The listing count went from 9,836 to 2022 is the 7,007. Is that we're saying that in 2022, right?
Those are closed deals.
Oh, these are closed deals. Gotcha.
Sorry, yeah. You're in the sold tab. So we went from 98.36 closed deals to 72.72.
Okay.
Now, what's really kind of interesting is if we kind of, let's just say we toss Q1, Q2 out the window, the market is operating like it is 2011, 2012.
Right.
which is a great market. We were able to go show homes. We were able to go get buyers. Values still increased. I still expect the year-over-year values for Central Texas to increase between the 8.5% and 10%.
Right, what we've been saying
now for 3 quarters.
Yeah, right. I was about to say that. And the close price to list price ratio, whereas last year was 104, it's still 99%.
99%. And now the most current month is 97.7. But still, those are great numbers because historically, if we go back and look at the last 20 years, that close ratio fluctuates between 96 and 98.
Yeah.
So I get excited because we're back at a normal market.
Yeah. Now, what about? I'm going to try and pull up a screen here with your with something you sent me last night, really quick. Let's see. Let's look at that was. You had withdrawns, I think, right?
Oh my gosh, yeah. So withdrawn. So last night, I was talking with an investor, and he's like, "Hey, what are W's doing?" So I actually went back and looked at what withdrawns we're doing for the last 22 years, quarter by quarter.
Yeah.
And honestly, our withdrawn sales. So people who aren't familiar with withdrawn sales, those are people who have chosen not to sell a house.
Yeah.
They just completely come off the market. Some of us in the industry will argue that that's just shadow inventory that's available. And I feel sorry for some of you withdrawals that are getting hounded by cold calls.
Yeah.
Because the reality is there's a lot of people who farm those quite aggressively.
Yep.
So we had the largest spike in withdrawals that we've seen in the last 20 years. When we go look at it from a unit volume perspective, it was 2021 Q3, the last time we had withdrawals at this level.
Gotcha. Which would seem pretty alarming on the surface, but you also have to remember, is a big majority of this are people that had unreasonable expectations that may not need to sell, but they're late on, like, I'm going to cash in on the property and I haven't seen the news in 4 months, right?
Correct. Now, what's crazy, let me pull something up here. I'm going to open an Excel chart because I did not, this data was raw. I was kind of doing this last night at 9 p.m., so I didn't get a chance to audit it and go through. The average withdrawn sale in Q3.
And if you want to send that to me, I can pull it up.
It's a raw Excel file.
That's fine. That's fine.
Yeah, the average withdrawn price was $825,000. So if you think of the average closed deal was $641,000. Those were just opportunity sellers exiting the market.
Huge. That's a huge point there. And just think about this, right? If they needed to sell, that means that they bought their property in the last year. And because I mean, the only way you're not going to be able to sell your property is if you're trying to go back further than 1 year's value.
Correct.
So what it means is you lost your opportunity for the gain of the last year. That's not that big a deal.
No, and if we kind of step back and look at it from that perspective, Ryan, which is a great perspective. If you look at our peak value of 690, that's the best quarter we've ever had. Really, these 5% movements is just kind of the normal churn in the marketplace. Quarter over quarter. It's not uncommon to have our hills and valleys where we go up, we come down, we go up, we come down. It's a very oscillating number.
Yeah.
It just so happens the last 2.5 years it was just straight up. And now we're returning to that oscillating business place where, hey, I still think the best price for getting record values is March to April every year.
Right.
You want to set records, bring your inventory on in March and April.
Okay, so let's polish off our crystal ball here and talk for just a second, right? I was reading the New York Times article this morning, the morning newspaper. It talked about, the interest rates going up and what the Fed's going to do and all that. And there's two camps. One is a camp that says that we've already done enough, but we're not going to be able to we're not going to see the effects of what of the interest rates rising for a few more months. And as evidenced by that, I think Amazon either stopped hiring, or I forget what the article said. They either stopped hiring, or they either stopped hiring, or that they may have made a first round of layoffs. Okay. And the reason they explain, and which I thought was a really good explanation, is that when prices go up and costs go up, consumers will pass that on businesses and people that manufacture products will pass that on to the consumers, right? So when they raise the price of what it costs to borrow, it kind of slows that down. So the first camp was, okay, let's stop, because otherwise you're going to have stagnation and you're going to you go too far. The second camp is that they haven't gone far enough. So
Yeah, so I'm gonna drop a good name here. I talk with David Cutler, who's an economist at Harvard, pretty frequently. And when I started talking to him about these shifts in the Fed and what they're trying to do, and he was very just honest and said, hey, they're trying to slow the car from 100 to 55. Unfortunately, it's not like a regular car where you know how much brakes to press.
Yeah.
So it's a big, let's tip our toes in and see what happens, and then we wait and see.
Yeah.
So I agree 100% that the Fed is going to go through this cycle of we're going to touch this every 90 days. We're going to take some abrupt actions. Powell has committed, and if you go and read his lectures, and if you go listen to his talks, he is committed to hurting demand on the demand side to fix the supply chain crisis that we've been in the last couple of years. And he's going to do everything he can to temper it, to really make it where if you're in the marketplace for anything, it's because you need to be in the marketplace, not because you want to be in the marketplace.
Right.
So I think we're seeing a big shift in the want and needs coming out. And I really believe the 7,200 homes that got sold this last quarter are people who needed to do something.
Yeah.
Not wanted to do something. Where the withdrawns being 2,200, 2,300, those were people who wanted to sell, but they didn't need to sell.
Gotcha. And by the way, I think you're going to probably see less withdrawns moving forward because, the public is always 4 months behind, what real estate professionals know.
Exactly.
Yeah.
Exactly. I think Q1, Q2, we're going to see some normalcy come back to the marketplace.
Yep.
I think our unit volume is going to be hovering someplace probably in this 2010 to 2013 range, if we have to pick a period to look at. Values, I'm going to stay optimistic. I hope that 2023 we're kind of 0 to down 5%. I hate to say it because I'm a Longhorn fan, been a Longhorn fan for decades. It's a rebuilding year next year.
Yeah.
Let's just get through, have one good normal year without a 144-hour freeze, without mortgage rates messed with, without quantitative easing coming to an end, without any volatile shakes in the marketplace. And God, 2023 might just be a normal year.
Right.
Would be awesome for the market.
Yeah, and you know what's interesting? I've been saying that we are, 4 or 5 headlines away from another rush here in Austin. I also saw this morning in, I think it was the New York Times, it said Micron committed to a $100 billion plant in upstate New York.
Yes, over Lockhart.
Well, I didn't read that, but that was what my assumption was, that it was over Lockhart.
Yes, the New York brought more incentives to
Yeah.
the table than Lockhart in Texas could.
Yeah.
And that kind of surprised me because New York is such a tax-heavy state
Yeah.
that I do everything I can to avoid New York taxes. My wife's a road warrior consultant, and there have been years where she's had to work in New York. And the tax laws in New York have actually tried to come after the wages in Texas I earn.
Yeah.
Because of her touching her toe on the ground in New York. And that just surprised me.
Yep.
But then at the same time, the Midwest, and let's just call it the Rust Belt, the Chicago to Pittsburgh to Rochester, they've lost their heyday of automotive manufacturing.
Yeah.
But maybe these states have kind of gotten bright to the idea of we need high-tech manufacturing. Let's stop chasing cars.
Yeah.
And let's move it to the new economy.
Yeah, well, so if you're watching this and you were betting on, and did a gold rush to Lockhart because of the Micron, this might be disappointing news. But I still think Lockhart's got a lot of stuff going on there.
Yeah, I think Lockhart's going to become that sleeper community that's going to provide affordable housing. That's going to be manageable to get in and out of Austin.
Yep.
And will be a good place for people to start, considering their first-time home purchases, kind of like Cedar Park was 20 years ago.
Yeah. Yeah.
Cedar Park's changed drastically in the last 20 years.
Yeah, so let me ask you this. Do you think that next year we're going to see a decline in value? I mean, not from, February to February, but from next February to next February. Is that what you mean?
I'm going to remain optimistic because if we go look at every economic downturn that's happened since 1990 in Austin, the impact's been minimal, 1 or 2%.
Yeah.
But you know what shoots up fast falls fast. And
I know.
we're one of the fastest markets to shoot up, so that's why I kind of remain guarded. And what I think next year is going to provide on us, and I don't know. If we're going to go negative, I think it's going to be small.
Yeah, I'm going to go on record and say that we might have what when I first got into business was historic appreciation. And I remember when I first got into the business, it was 4 to 6%. You know, that.
What year did you start, Ryan?
I started in 2004.
Okay, I started in 07.
Yeah.
So I started at the peak of the market in 07, and I rode that pony all the way down to the bottom. And kept doing my notes, calls, and Popeyes, and survived the last downturn.
Yep.
And survived this next downturn.
Now, what I would agree with you in is that I probably wouldn't give that prediction if I weren't in Austin. You know.
Yeah. Yes.
I think that we're going to buck the national trend, and we always have, right?
Absolutely. You know, if we were in, I'm going to throw St. Louis out there.
Yeah.
If we were in St. Louis, I'd probably be really, really scared right now. Mm-hmm. I would be worried about upside down values. If I was in some of the suburbs of Detroit, I'd be scared about where value's going. Because if you go look at some of these larger cities, they're about the size of Austin.
Yeah.
Man, their home values are like a dog tail wagging every time there's a recession.
Yep.
And here, we just kind of chugged along. You know, it's never been not a good time to buy a house. It's never not been a good time to in real estate in Central Texas.
Yep.
So I tell everybody, if the time is right and you can afford the payment, buy something.
Yeah.
You know, I'm not going to say date the rate or buy the home, date the rate, because guess what? If values shoot down, you can't refinance in 18 months.
Yeah.
You've just eaten your words. At some point, you'll be able to refinance. At some point, you'll be able to work yourself out of it. But
sure, you will. But look, here's the thing with that, right? And I agree with the buy the home, date the rate. Okay, but you also have to figure that what is going to be the new normal? The new normal is going to be the old normal. I mean, you know, we may see 5%. I don't think we're going to see under 5% ever again.
Yeah, I don't know.
I don't know either. I'm just saying. I never saw it before. You know, 2000. What is it? 8? 2017.
We got below 6.
Yeah, 2017, right?
Yeah. No. Well, the rates got below 5 in like 17.
Yeah.
And they were below 6. We were all super excited. And, you know, we were always saying in 2009 going, rates have never been this cheap. You got to buy.
Yeah.
You know, we had said that for a decade.
Yeah.
And it just kept getting cheaper and cheaper and cheaper.
Yep.
So, but what surprised me out of all this stuff, Ryan, is how strong the dollar has remained on the global currency markets.
Yeah.
It's never been cheaper to go visit than right now.
Yep.
And so that's what's just surprising is even no matter how bad we say it is here with inflation, no matter how bad we say it is here, when we go look at it from a global perspective, our currency is stronger than it's ever been. Mm-hmm. You know, we're still relevant in the financial markets globally. Mm-hmm. This is just a hiccup in time. We're still young enough that, hey, if we have a small downturn, we'll make it up. You know, I worry about our baby boomers that are retiring now and their portfolios might be taking a hit. But us young guys who are under 50, man, there's plenty of time to go make more money and invest and make smart purchases.
Yeah, and the one thing I just want to push forward here is like the moral to this story, in my opinion, is that, you know, I think that we're going to have more demand in spring. You know, very, very likely that interest rates are down a little bit in spring. Okay, and then if you're looking at buying, buy now. Like, you know, buy down your rate is probably the best advice I've gotten, and you can do that with concessions from the sellers. I mean, this is ridiculous. Like, I pulled a HELOC loan out of my house, got $1 million out, so that I can buy on a whim whenever I want. And I'm looking for opportunities, and even now looking for opportunities, they're not like out there like crazy. You know, they're not like killer deals. So.
No, there's no value shopping yet.
Yeah.
And I don't know if it's going to come in. The advice I've been giving my investors in my investor pools are, let's see what happens in Q4.
Yeah.
Let's watch Q1, Q2, and then decide if we're going to dip our toes in and kind of battle it out.
Yeah.
But historically, Q4, late Q4, November, December, there's usually a bump in real estate values.
Yep.
So these next 60 days may be the cheapest time to buy real estate.
Yeah.
Because let's say we go back to a normal curve next year, we get it back on our 6% wagon. I'm wrong on the 0% to -5.
Mm-hmm.
October, November are going to be the best months to buy a home.
Which they typically are.
Yeah.
Yeah. Well, okay, that's a good note to end on it. If you're watching this, and you have any opinions at all, if you think we're full of shit, please put it in the comment section. If you think we're right, let us know. If you have a different prediction, please let us know. I want to hear what people have to say. Chris and I have been doing this all year long. We're going to continue to do this. I think we're going to be speaking at the ARAP event. I don't know. Did you commit to that?
I haven't yet, but who knows?
Okay.
Oh,
and then we're having a summit on January 20th for our Spyglass agents for half the day. And the second half of the day, we're going to bring in panels. I want you to be there and speak for us, if you will. It'll be a great event. We're going to have, we'll have up to 100 agents outside of Spyglass at that event. So if you're interested in that, drop a line to me. And anything else, Chris?
No, man, I appreciate your time. This has been always enjoyable and pleasurable, so thank you.
Yeah. All right. Well, let's see, how do I end this broadcast? This is new right here. Let me finish.